Hello everyone, welcome back to another video with me. Today, we are going to review one of the ICT strategies that has a high win rate, the unicorn strategy. As ICT himself says, the strongest algorithmic entry pattern you can have. This alone is very telling that this model is extremely effective. Okay, let's get started and take a closer look at it. What is the ICT unicorn strategy? The ICT unicorn model trading strategy in the ICT style is one of the well-known strategies in the world of forex and financial market trading. The ICT unicorn is a trading strategy that aims to predict sharp price movements in any market, including stocks, crypto, forex, and futures. The strategy uses two concepts from ICT's teachings: fair value gaps and breaker blocks. FVGs are imbalances in the market that occur when price jumps up or down extremely fast. Breaker blocks are structure changes that occur when an order block fails. To properly understand and execute this strategy, you must understand these concepts. In the unicorn strategy, traders seek points where the probability of price reversal or trend continuation is high. This strategy is primarily based on recognizing and analyzing price action patterns and market structure. The unicorn model consists of four main components: time, liquidity sweep, a FVG, and a breaker block. Time is always the most important. It will always be time first, then price. We want to be utilizing unicorns within ICT's kill zones, preferably at open times. We only execute during the opening times. Step 2. Liquidity sweep or SMT. The next step to identifying a unicorn model is to look for a liquidity sweep. SMT divergence also makes this setup valid, but to keep things simple we will be looking for a liquidity sweep. The breaker block. The next step is to identify the breaker block that is created. A breaker block is a specialized form of an order block that changes its role after a key market level is broken. Typically, an order block is an area on the chart where large institutional orders are likely to be placed, providing strong support or resistance. However, when this area is breached, and the price moves in the opposite direction, it transforms into what is known as a breaker block. This shift indicates a reversal in market sentiment, turning the previous support into resistance or vice versa, thereby signaling a potential trend change to traders. The significance of the fair value gap. The fair value gap refers to an area on a price chart where the price rapidly moves through a level, leaving behind a gap. This gap represents an imbalance between supply and demand and is often seen as a potential area for price to return and fill the gap. These zones are crucial for traders as they can indicate future price movements, providing opportunities to enter or exit trades. When an FVG overlaps with a breaker block, it forms a highly significant trading area known as a unicorn. This overlap creates an ideal zone for traders to enter the market, as it combines two powerful technical signals. The unicorn model is therefore considered an optimal strategy for identifying precise entry and exit points in the financial markets. So, only execute during opening times. Higher time frame liquidity and lower time frame liquidity needs to be taken. At the higher time frame liquidity, the lower time frame liquidity needs to be taken. After stop hunt occurs, we need to see clear and decisive displacement. The displacement needs to leave an FVG aligned with the breaker block. We must confirm all criteria to the entry function is completed before entering. Once criteria is completed, we enter from the unicorn with a stop on the other side of the entry function. Must size position according to the size of the entry function. When executing, we are looking for two risk to reward. We execute the unicorns that are aligned with higher time frame order flow. If any of these justifications to your actions are missing, this is the first thing showing you to not participate. We are only allowed to participate when all concepts are. Preferably 1% per trade is optimal. We are only allowed to participate once per session. There is no revenge trading. There is no overtrading. Only once per session, and that is only when all criteria is aligned. Risk during participation should be 1% or lower per trade of your total account size. That's right, there is a unicorn setup, folks. That is one of the wonderful setups that repeat over and over again. It's there every single week multiple times on many different time frames. This setup alone is a model in itself. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos.